Last year, investors poured more than $600 billion US into bond funds globally. Now, of course, we've seen a drop in the stock market this year, partly because of uncertainty over policy in Washington, tariffs, etc. Bonds still in favor. Let's get more, and we are seeing some flows into the space still, especially at the short end. We're joined now by Rieder, Chief Investment Officer of Global Fixed Income for BlackRock. Great to see you.
Thanks for having me.
Give us a ballpark. How much in bonds and fixed income would BlackRock manage, roughly?
So just under $3 trillion of fixed income. So it keeps us busy.
Some mostly in ETFs or no?
So more and more, the growth has been clearly in ETFs, but also in mutual funds and in other structures, separate accounts, institutional mandates, et cetera.
And the flows you're seeing this year into bonds, mostly into at the short end?
Yeah, I mean, it's changed. I mean, so we came into this year, and it was interesting. I said it once, that we went like animal spirits into animals in hibernation, meaning like everybody was take risks, let's take risk, and then it changed. So it started the year, tremendous flows into high yield loan markets, and that's reversed. And now it's people looking for being more cautious, front end of the yield curve, short-term bonds. Now that changes, but today it's definitely been more short end, a bit more high quality, and stay a bit cautious for the time being.
You don't hear as much talk these days about money market funds. I know they're very boring, and you know the unit never changes from $10. But have they been replaced to some extent by short-term bond ETFs?
So I mean, the cash markets are still very large. But what's happened recently is people have said, "Gosh, you know, the yields you get in the short end, and not just in traditional treasuries or government, but also to buy credit, and so short-term bonds." And maybe go a little bit longer to lock in these yields. I mean, these yields, you know, we're running through a higher spate of inflation. You're locking in yields that we haven't seen in a long time. So we've seen some people say, gosh, let me get some 2-year, 3-year, 5-year paper to lock in some of these yields.
Right. And what about the U.S. bond market? We saw that drop in U.S. bonds. Let's have another look at the yield on the 10-year. And it's still up from a few weeks ago. But, of course, still shy of that psychological 4.5 or even 5% mark. Is there a risk of a permanent loss of confidence in U.S. government bonds?
So, you know, listen, I think the U.S. is going through some challenges today. I mean, the amount of debt in the United States is too big. We got to bring these deficits down. We got to get spending down. So, you know, there is some concern about rates moving higher. That being said, you know, part of what's super exciting about the bond market today is if you're staying in the front end of the yield curve or the belly of the yield curve, these yields are very attractive. And buying, you know, things like floating rate in securitized assets, these yields are very attractive. Listen, can rates still move up a bit more? And, you know, we're going to go through inflation, you know, higher levels of inflation. If you look at where core CPI is running, you're still running at 3.5% inflation pre-tariffs. So you still got a bit more inflation coming in. So, you know, part of what I think in terms of managing fixed income today, stay shorter on the curve, build a bunch of yield in the portfolio, keep it stable, and then, you know, we'll see where the peak of interest rates are. But listen, I don't think rates are going to move that far, but could you still have some elevation, particularly longer on the yield curve in 10 years, 30 years? You can. You saw it play out yesterday in a pretty aggressive fashion.
One of the funds you guys manage is the iShares Flexible Monthly Income ETF. The symbol is XFLI. And I'm showing a unit price as of today of about $39 Canadian. What is the yield on that? Now, your website is showing a yield north of 6%. Oh, that's average yield to maturity. So what is the current yield? Can you give us a ballpark?
Yeah, so we're running at over 6%, actually about 6.5% yield today. And actually, we use something that looks at the forward yield curves where you should roll down to, and it's actually close to 7. So the nice thing about this fund today is you get a tremendous amount of yield, and we buy high quality assets. It's got an average rating that's high BBB rated. So you think about in history, be able to get in the 6s is actually 7 on a true level basis. To get that sort of yield at what is a high BBB rating, so investment grade rating, and by the way, we're running a duration or interest rate exposure that's under 3 years. So we don't have to go, think about fixed income. It used to be you had to lend long.
Yes.
And you don't have to today. You can stay in 3 years, get that sort of yield, and still stay in good quality. We use some of the high yield market. We use some of the loan market. But boy, it's a pretty high quality portfolio overall. You use things like AAA mortgages, et cetera. So it's a pretty unique point in time to get that yield.
I know yields, I mean, I'm looking at my Bloomberg screen now, and it has the 12-month yield at about 3.6%, and the net indicated yield at almost 6%. So there's different ways of calculating yield, I guess.
Yeah. Well, so there's a couple of things. There's also what the total return is over that period of time with interest rates have moved higher.
Yeah.
So the total return has come down a bit because rates have moved higher. But the yield that you actually capture for somebody that buys into the fund today, that's a yield you're actually getting. Now, rates can move around, whether you achieve that higher or lower. I mean, the nice thing today, you're getting this benefit of rates having moved up. And then over the next, and look what the markets are pricing in, you get a Federal Reserve that's going to start to cut rates. The ECB is cutting rates. So, that's why these yields today are pretty attractive. If you believe, Bank of Canada, et cetera, you believe these rates are going to come down, which I think they will.
I know we can't get into the full mathematics of it here, but when you say the yield is north of 6%, but you're not holding securities that yield more than 6%, are you?
Yeah, we are.
Oh, I
yeah,
see.
Yeah, so if you take the average yield of the securities we hold, yeah, it's over 6%. So by the way, a lot of it is you buy international, like we buy a lot of European rates. You get a benefit being a dollar investor, so we swap them back to dollars, then obviously, here in Canada. And so your yield that you're capturing, and by the way, now in parts of the high yield market, you're getting 8 to 9% without going into really low quality, being in double B, single B. So it's at a pretty attractive point in time. And in floating rate debt, and even high quality floating rate debt, like parts of the mortgage market, parts of the CLO market, you're getting an awful lot of yield today.
Well, we have to leave it there. Thank you very much indeed.
Thanks for having me.
Really appreciate it. Rick Rieder, Chief Investment Officer for Global Fixed Income at BlackRock. Coming up, 10